Hi everyone, welcome to Value. So today I thought I might just go through how you examine probabilities, especially when it comes to investing. And when I saw this article of the board possibly re-examining Elon Musk's $43 billion bid, I thought, basically this is the perfect example where probabilities as an investor probably comes through more than ever. Of how you can look at a situation like this and go, is it worth investing into? Because, like, on the face of it, you go, oh well, it could be a half and half, right? Because you've got this uncertainty, and you go, well, if the board's really looking at it, then it might be okay. So we look at the share price right now, and it's $48.93. Elon Musk's bid is for $54. So you've got an upside of around, just over $5, or about 10% upside. And that's your upside. So when you look at probabilities of investing, you look at your upside, which is your reward, and then you look at your downside, is what you lose if things do not eventuate. So you have a situation, share price $48.93, goes up to $54 if it works out. But potentially, if it doesn't work out and the board goes, we only did this because we didn't want to be liable from the general shareholders. Because if the board turns this down now and potentially the share price languishes around $30 in a year's time, then this opens a lawsuit to the directors, because shareholders will be like, you turned down an offer where I could have got a premium for my shares, but now I can't get a premium for my shares and are worth much less. So particularly with the US, where lawsuits are just rampant in that sense, that anything goes when it comes to suing. And if you're a shareholder and your shares are $30 and you could have gotten $54 a year ago, and you got a board has done nothing to change this around, they inadequately valued the company wrongly, and it was worth less at the time. It was worth less than $43 billion, and they should have accepted $43 billion. So that's where your probabilities comes in. That in that case, the board might just look at it seriously, just so they're not liable. And in that case, if the share price drops to $45, then potentially you're looking at more or less the same kind of loss. So where your upside is around 10%, your downside is around 10% as well. And potentially over the longer run, your downside could basically come down to the low 30s. That's where the share price was at before Elon Musk even took an interest in Twitter, and that was where the lows were. Potentially at that stage, the company was probably selling at the bottom, and we might go, okay, potentially it might have been holding up around mid 30s anyway. But at that stage, you're possibly looking at possibly a downside of around 30%. And with a downside of around 30%, then all of a sudden it starts to become clear. Like, if your upside really right now is maximum 10%, but potentially as much as 30% loss if you get it wrong, then you can look at those probabilities and go, this is not a decision worth taking. Potentially, you might be okay about it if you go, Elon Musk is going to take this company private. I don't mind being a shareholder of a private company, which means you can't just sell whenever you want. Then you could also consider it that way. But in terms of investing as a normal stock investor for unlisted companies with no interest of the company being private, then at this stage you'd probably be looking at upside 10%, downside 30%, not worth the deal at this current share price. If it drops any further, then potentially it makes the upside a bit larger to even up the downside. But in all cases, the upside should definitely outweigh the downside. If not, it's really not worth doing. And that's how I would, anyway, re-examine kind of just how things work on probabilities when it comes to investing, and how you should also look at it as well if you never thought about it that way. Like, let me know if you've got a different thinking process as well. Like, that's my thought process when it comes to this. Like, for me, when you look at it under naked eye, and you go, it's at $48.93. If the takeover happens, it's $54. It seems quite appealing, but it doesn't seem that appealing now when you look at the downside. The downside potentially is more heavier than the upside. So that's the case of that when it comes to investing. And hopefully you learned something from that, or you could add it to your thought process when it comes to investing. That, hey, don't just look at the face of things as it is. Look at the whole general scenario, and always take it serious in that sense that, hey, nothing is guaranteed. And because nothing is guaranteed, you always want to examine your upside versus your downside before you do these things, rather than being quite YOLO about these things around, I'll just do it and see what happens. Which which can end quite tragically if you just go at it without a backup plan. So always think about what happens. Like, most people do just think about what happens if things happen their way, because apparently we all just believe we have much more luck than we would normally have. Like, we always hope. Like, it's kind of like someone buys lottery because they have that hope that they could win. Or else you wouldn't really be buying it if you didn't have that hope that you could win. And that's the thing. If you buy lottery, you're likely a person that has more hope than kind of realism on probabilities. But it never hurts to have hope. But in general investing, you probably should be realistic around those probabilities. Like, say you buy it and it works out, potentially that just leads to more risk taking in the future. So you just want to balance your views, your perspective around these things, particularly when it's around money and investing. That's what builds a good approach to your investing. I think that's all I more or less have to say about that topic. Until then, good luck investing, everyone.